Welcome to the deep dive. Today we're really getting into the weeds on the Q3 2025 earnings from a major airline. We've got the call transcript, the press release.
And it's not just numbers, is it? It's about what they're calling the most significant transformation in their history. Big words.
Exactly. So our mission today is pretty straightforward. Pull out the key financials, sure, but really unpack the strategy. These are huge changes happening fast.
And the timing is crucial. These Q3 results, they're framing them as proof the whole thing is working, record revenue, beating expectations. That gives them the green light to push even harder on this new direction.
Right, a direction that's, well, kind of a pivot from their whole identity, moving towards premium.
A massive pivot.
Mm-hmm.
So let's start with that proof point, the financials. Because like you said, beating expectations right now, that's the real aha moment for anyone watching.
Okay, section one, the financials. Lay it on us. What did Q3 look like?
Pretty strong, actually. Top line.
Yeah.
Record third quarter operating revenues. We're
Yeah.
talking $6.9 billion.
Wow, okay. Record revenue. And profit.
Yeah, if you strip out some of the special items, the net income was $58 million. That works out to $1.11 per diluted share.
Yeah.
Solid ground to stand on.
Solid, yeah. But the unit metrics often tell more of the story, right? How efficiently they're making that money.
Absolutely. And this is where it gets interesting. Unit revenue, RASM, revenue per available seat mile, that was up 0.4% compared to last year. A bit better than they guided.
Okay, better than expected on revenue efficiency. What about costs? That's usually the tough one.
This is the kicker. Unit costs, CSMX, that's cost per seat mile, excluding fuel and a few other things, it only went up 2.5%.
Only 2.5%. Wasn't the forecast higher?
Well, higher. They beat the low end of their own forecast range on cost control.
Yeah.
So you've got revenue beating expectations, costs coming in way under.
Yeah.
That's pretty disciplined execution.
But is it sustainable discipline or just a good quarter? We know costs like labor, fuel, they don't just disappear.
Management is really hammering the broad-based cost discipline message. They seem to see this ongoing focus as insurance is the word they used.
Insurance? Insurance for what?
For hitting their big 2025 target. They reaffirmed the full-year guidance for EBIT earnings before interest and taxes, that $600 million to $800 million range. Given all the economic uncertainty, tight cost control is their safety net.
Makes sense. And they're showing confidence, too. They returned, what was it, nearly $500 million to shareholders.
Get this, $439 million. Dividends and share buybacks. That's not just talk. That's putting serious cash behind the belief that this transformation plan is going to pay off.
It signals they're confident the money coming in isn't just being sunk into changes, but is already generating returns.
Exactly. Proof of performance right out of the gate.
Okay, so the financial foundation seems solid, even strong. But let's get to the core change, the really radical stuff happening in the cabin. The big one, ditching open seating.
This is it, Section 2. Assigned seating, the centerpiece. They started selling assigned seats and extra legroom options back in July for flights starting January 27th, 2026.
So still a few months away before passengers actually experience it, but they have early data already.
They do. Bookings are apparently in line with expectations. Okay, fine. But the really interesting bit, the phrase that jumped out, was this knife-edge yield improvement.
Knife edge. What does that mean in practical terms?
It means for flights booked after that January 27th start date, they're already seeing slightly higher fares, essentially. People are willing to pay a tiny bit more right now just for the promise of picking your seat later.
Huh. So the market is sort of validating the concept before it even launches.
It seems that way. It suggests the pricing power is real. And there's more customer data supporting this.
Right, the Net Promoter Scores, the NPS.
Yeah, they said NPS is already 4 points higher on the planes they've already retrofitted. It's over 400 aircraft.
And the retrofit isn't even the assigned seating part, right? It's the other stuff.
Exactly. It's the new interiors, bigger overhead bins, power outlets at seats, better lighting. So customers are already liking the physical upgrades even before they get the benefit of choosing a seat. That bodes really well.
Okay, it sounds positive. But let's talk numbers here, the targets. They're projecting over $1 billion in extra EBIT just from this seating change in 2026.
Over $1.several billion incremental EBIT in 26, ramping to $1.5 billion full run rate in 2027.
Yes, that seems incredibly ambitious. $1.5 billion just from letting people pick seats.
It's huge, no doubt. But it reflects their belief that the old open seating model was leaving massive amounts of money on the table. They think this, plus the better cabin, lets them finally capture revenue that always went to competitors offering, a more standard product.
If they hit that $1.5 billion, it's a game changer for their whole business model.
Totally transforms the economics. But they're not just relying on seating. Section 3 is all about widening that revenue net further.
Yeah.
Ancillaries, loyalty.
Right. The other ways airlines make money beyond the ticket, what's new there?
They're rolling stuff out fast. Free Wi-Fi started in October, but only for their loyalty members. Sponsored by T-Mobile. Smart. New distribution, they partnered with Priceline, so not just selling on their own website anymore. And they launched their own vacation package thing, Getaways by Southwest.
So, modernizing the toolkit, basically. Catching up. What about the loyalty program itself, Rapid Rewards?
That seems to be humming along. Loyalty revenue up 7% year over year. And they had a big push on their co-branded credit cards.
I saw that, the 100,000-point offer.
Yeah. Drove double-digit growth in card signups, highest activity they'd seen in like 5 years. That loyalty base is key.
And it connects to maybe the most surprising number, the checked bag revenue.
Ah, yes. This one's fascinating. The sources say their checked bag revenue per passenger is now, and I quote, right along the same lines as the big three.
Wait, the big three. The ones who charge for the first bag, second bag.
Exactly. And this airline, famously, still gives you 2 free checked bags.
So how? How are they making $1 billion a year, which is the estimate, from bag fees if the first 2 are free?
It's mostly from excess baggage. Think third bags, fourth bags, overweight bags, oversized items, and potentially also people having to check bags at the gate if they don't fit in the new, sometimes smaller overhead bins on those retrofitted planes.
Ah, okay. So they're capturing that ancillary revenue without actually ditching the core bags fly-free promise. That's clever.
Very clever. Keeps the brand message mostly intact while closing a huge revenue gap. It's impressive.
That discipline flows into operations too, right? Section 4. They seem proud of how reliably they're running things.
Extremely proud. They pointed out they're currently #1 year-to-date in the Wall Street Journal's airline rankings for operational performance.
That's a big deal for passengers. Reliability is key.
And they gave a specific example. Remember that telecom outage in Dallas back in September? Caused FAA ground stops everywhere.
Yeah, that was messy.
Dallas Love Field is a massive hub for them. Huge presence. Despite that chaos, the sources say they had only 1 cancellation that entire day. 1.
Seriously,
Yeah.
during a major ground stop at their hub.
Yep. That shows incredible operational resilience. That's the kind of thing frequent flyers really notice and value.
Okay, so running smoothly. What about growing? Where are they pointing those planes next?
The new map is interesting. For 2026, they announced Knoxville, Tennessee. Okay. St. Martin in the Caribbean. Nice. Santa Rosa, California.
Wine country. Makes sense.
And the big one, Anchorage, Alaska. Their first ever flights to Alaska.
Alaska. Wow. Okay, that's definitely pushing the boundaries of their traditional network.
Absolutely. And it ties into this longer-term strategic thinking. They're actively looking at more, well, premium revenue streams.
Like the airport lounges you mentioned.
Exactly. They confirm they're doing customer surveys about lounges, about maybe more premium seating beyond just extra legroom. Part of this is closing what they call the other revenue gap.
Which is often tied to things like high-end credit cards that offer lounge access.
Precisely. And they even mentioned exploring long-haul international destinations, maybe using partners. They hinted at someone like EVA Air for Asia connections.
Okay, lounges, maybe long haul. This all sounds geared towards a specific type of traveler.
You got it. The corporate travel. That assigns seating change. It's not just for families wanting to sit together. It's a direct play for more business travel.
Why specifically?
Their share of the domestic managed business travel market is only in the mid-teens. That's actually below their overall share of domestic capacity.
So they're underperforming with corporates compared to their size.
Right, and corporate travel managers, they need predictability. They need structure. Open seating was a major barrier. Offering assigned seats, potentially premium options, that unlocks the corporate market for them in a way they couldn't before.
Okay, that makes sense. Before we wrap, let's touch on Section 5 capacity and costs and how they're balancing things, especially with, the shaky economy.
Right. There's an interesting decision they made for Q4, the current quarter. They actually increased their planned capacity growth by about 2 percentage points, up to roughly 6% year-over-year growth.
They added capacity. How, when they're also retrofitting planes? Ah, that's the trade-off. They delayed the retrofitting schedule for their 737-700 fleet. Those retrofits involve taking out 6 seats per plane.
Okay, so by pushing the retrofits back to January 2026,
They keep those extra 6 seats per plane flying through the busy holiday season. The thinking is capturing that extra holiday revenue, even if it slightly dilutes unit revenue.
Because you're selling more seats, potentially cheaper ones.
Right, it's slightly RASM dilutive, but it brings in more total profit. It's EBIT accretive, they said, because the cost of keeping those seats flying for a few more months is almost nothing compared to the revenue they generate in peak season.
So a short-term cash grab, basically, to maximize holiday earnings.
A smart tactical move to bolster the Q4 numbers and support that full-year EBIT guide, especially given the headwinds.
Yeah, they mentioned headwinds, like the government shutdown impact.
Exactly. That can hit travel demand. Fast government travel stops, then related contractor travel slows down. So they're being cautious, not assuming any big economic upswing beyond what they saw back in July. Which brings us back to cost control as that insurance.
Yep. They're actively looking for more cost savings to protect that EBIT range. It allows them to reaffirm the big picture targets for all these initiatives combined. What was it, $1.8 billion in EBIT contribution for 2025?
And the massive $4.3 billion target for 2026. They're saying that's all still very much still intact.
The message is clear. We know the economy's uncertain, but our transformation plan is working, our costs are under control, and we're hitting our numbers.
So wrapping this all up for you, the listener, it's kind of a remarkable story unfolding. You've got this iconic airline hitting record revenues while simultaneously pulling off this huge fundamental shift in strategy. Assigned seating, premium focus, new markets, aggressive ancillary plays.
And the execution seems, well, pretty stellar so far. The pace of change is undeniable, and these Q3 results give them a lot of momentum.
The big takeaway really seems to be that the original low-cost egalitarian model, its inventors, kind of moving beyond it, chasing that premium dollar, that corporate contract, that broader network.
It's a fundamental shift from just getting you there cheap to offering a more structured, potentially premium experience.
Which leaves us with a final thought for you to chew on. Think about all these pieces together. Flying to Alaska for the first time ever, seriously exploring airport lounges, using assigned seating to win business travelers, talking about partnerships to Asia.
Yeah, when you put it all together.
What does it really mean for this brand long term? When the ultimate low-fare champion starts layering on all these premium features, how much of that original scrappy low-cost DNA can possibly survive when you're chasing a $4.3 billion target built on higher yields and ancillary fees? Are we watching the birth of a completely different kind of airline?
That's probably the question for them and maybe the industry over the next few years. How far does this transformation go?
Definitely something to watch. Thanks for diving deep with us today. We'll catch you next time.